Now, let's talk about how this is going to affect us today. Let me go on record here. I believe that in a year from now, and in particular 5 years from now, and most certainly 10 years from now, this pandemic is going to have zero influence on where the Australian property market is going to end up. And the entire Australian property market is not interlocked, all right? It's markets within markets. And the first properties that get affected by economic turbulence have always been those located in lifestyle, holiday, regional, and mining areas. Providence does not recommend investing in these areas. Now, outside of those just mentioned, it's likely that the more expensive and top end of the property market is going to be the hardest hit. And I've listed the top 10 most expensive suburbs in Australia with houses on the left, units on the right. Now, in Sydney, you've got your eastern suburbs. You've got Darling Point, Vaucluse, Double Bay. On the North Shore, you've got Manly, Seaforth, Dover Heights. Historically, these higher end markets drop in value when the stock market crashes. Now, the cheaper blue-collar suburbs where the local workers can't perform their jobs remotely and where there is a higher incidence of casual employment, now they're likely also to suffer significant price drops. And blue-collar suburbs are definitely mainly identified from the census based upon the category of work that they're doing. Now, some of these suburbs throughout Melbourne and Sydney include Miller, Barong, Oakley, Campbellfield, and Sadler. And the top three areas of Greater Sydney with the highest blue-collar populations are the Liverpool area, so Ashcroft, Busby, Miller. There's 51.6% blue-collar. Cabramatta, Lansvale area, that's 51.4%. Bidwell, Emerton, that's 50.4%. That's around the Mount Druitt area. So those are the areas that you'd be focusing on to see those type of falls in pricing. Now, we believe that well-located homes in established middle ring suburbs are likely to hold their value better. And suburbs like Bexley, Ashfield, Kensington, Marrickville, Coogee, don't freak out if your suburb's not on this list. These middle ring suburbs all share these particular characteristics. Now, they're usually around 18 kilometres from the CBD as a radius. They exceed the Australian median household income, which based on the last census was $116,000. They have a good or above average demand-supply ratio score. They've got a population that exceeds 6,500, and they're very walkable. They've got a walk score of 70 plus if you go to walkscore.com. Now, we believe that the initial reaction of panic from COVID-19 has relaxed, and the market's uncertainty has definitely weeded out uncommitted buyers and sellers. And I can tell you from experience, this makes participating in a market much more pleasurable and more efficient. For buyers, if you're taking the time to pre-organize a private inspection and attend an open home, well, you're a pretty serious buyer then. Buyers who had the intention of buying either late last year or let's even say early this year, but continue to be priced out of the market, they're coming back with hope in their eyes. They're hoping that they can get a discount, knowing that the seller who's got this property on the market, they're serious about transacting. Okay, and that's just changing the mindset of these buyers. Now, for sellers, we're seeing sellers who had aspirations of, big prices and a seller's market mindset from 3 to 6 months ago. They're realizing that we're now in a buyer's market. The tables are turned a little bit here. So prospective sellers are now aware of the conditions that we're currently in, and they're entering the market with lower expectations. They're discounting pricing, and they've got a flexible mindset. Now, depending on your idea of value, the pricing on most of the homes that we're seeing has dropped between 5 to 20%. Okay, that's on where it was a month ago. And that changes across different price points, styles, and locations. Now, this chart shows the amount of new listings. Okay, 2020 is in the orange at the bottom left-hand corner. It's obvious that those who don't actually have to sell at the moment are staying out of this market. That's why volumes have dropped so much. And we're seeing new listing numbers are tracking lower than they were a year ago, and they're likely to continue falling for the coming months. I don't want you, though, to make the mistake that everyone selling at the moment is desperate. Don't think that. Our agents on the ground believe that the majority of those selling at the moment are not distressed sellers. Remember, the government only shut us down 4 weeks ago. That means they moved really quick to sell their properties, which means they were already distressed if that's the case. But the majority that we're seeing, their main driver for selling their properties is that it's lifestyle. People are trading out or they're trading up. And you might think that's silly, but if you're selling a property that was worth $1 million before and you're selling it for a 10% discount, you're losing 100 grand. But if you're moving up to purchasing a $2 million property, just keep round numbers, you're getting a $200,000 discount. So you're actually still in front by 100K. So selling out to buy up makes a lot of sense at the moment. So you might be purchasing a superior asset, you might be reducing your risk, your exposure, lowering your debt, offloading for tax reasons. We get lots of clients that hit a 6-year threshold and they have a CGT claim and they just want to get rid of it so they don't have to be charged capital gains tax. They might be cutting ties for relationship reasons. They might be getting divorced. You don't know. So for buyers, their upcoming challenge here is definitely going to be at lower stock levels. That's going to be the issue. And this is always a frustration for active and committed buyers. It's a hopeless feeling when you're scrolling through properties on an app and the list is very short. So as the nationwide shutdown continues, we do believe that during the next 3 months, we're going to see a surge of properties just sporadically, just randomly, every now and then, depending on how people are holding on, of people offloading investment properties and holiday homes. So they're not going to be able to financially support them. They're going to have to get rid of them. They're going to drop pricing. Now, this chart shows the direction of national gross rental yields, and it's trending down. Historically, we see sharp increases in rental yields in the aftermath of a financial crisis. And this is because buyers they're more cautious and many postpone their plans to purchase a home. And this leads to an increase in renters, all right, more renters, because in the aftermath of the GFC, Providence was purchasing distressed properties in Sydney with rental yields that average 5.8%, some above 6%. So we definitely think that that's what's going to happen again. You're going to see a drop and then you're going to see a sharp jump. Now, we can see from this chart that the percentage of properties sold at auction at the moment is, prior to auction at the moment is the highest it's ever been. All right. And many auctions are being withdrawn. So 66% of properties sold at the moment are being sold before auction. Now, this clearly indicates that sellers are open to negotiation. So make sure you study up, you know what to offer, you understand what a 66W is, how to waive cooling off periods, etc. There's a lot of things that you can use in terms to get you that better price. Now, we've been buying well for our clients in the current marketplace, and I've only got time here to give you one example. There's plenty on our website, so please go and have a look at providenceproperty.com.au. But what I wanted to show you here is what we're achieving on the streets. Now, we identified this beautiful, fully renovated 1850s character home for our client 2 weeks ago. And the client came to Providence exhausted and understandably very frustrated because they'd failed to secure their ideal home and they'd been looking for over 14 months. Now, it takes the average Australian about 9 months, according to Domain, to locate, assess, and negotiate a property. So this person was way past that. Providence attended auction on the client's behalf, and it was passed in. Now, we were the highest bidder. And stamina was definitely required by the team here because after a 9 a.m. auction, we started negotiating. And we negotiated to exchange a contract with the vendor, with the seller, at 11:44 p.m. that evening. Now, we secured the property for $1,555,000. Now, this was $145,000 below the auction day reserve. And critical to the success of this purchase was extracting crucial information from the agent regarding the vendor's current situation. This included facts like they'd already bought somewhere else, so they needed to sell ASAP. So getting that information was obviously crucial to our success. Our buyer's thrilled. They're so happy with the purchase. They have a long-term view. If they get a little bit of a dip afterwards, they don't mind. They know they already got it at a discount.